up on the list. It's good to see regular attendance on that. And I would remind you that even I go to attend webinars and things like that, always adding to what I can try and understand about the markets. So again, thank you very much. Welcome to week 4. We're going to look at the building blocks of basically a trading plan, putting together some very simple ideas and a little bit of work around that. Just a quick look at some of my work as well as part of that trading plan idea. And so we'll get ourselves underway. The information contained in this material is intended for general advice only, does not take into account your investment objectives, financial situation, or particular needs. And FP Markets has made every effort to ensure the accuracy of the information at the date of publication. So you must consult a licensed advisor before acting on any information you may see or hear. A bit of background for those that are here the first time. There's a few I can see. For those that are here the first time, this is my background. I hold the Australian Diploma of TA. Got that back in 2003. I'm a certified analyst with IFTA, the International Federation, from 2004 onwards. I did hold at one stage ADA 1 and 2 derivatives accreditation. I spent 7 years on the desk with various Macquarie and RBS and Wilson and a couple of others. Currently, I am a member of the Australian Professional Technical Analysts Association, APTA. I do writing for Thomson Reuters, the Refinitiv side of Thomson Reuters. I submit some TA into there each week, and I write for First Prudential Markets, the black and white report, which you'll find on their site every Monday morning. It's just a bit of a look forward into the week, and a contributor into Trading Edge magazine, and I currently trade my own accounts. Always keep your desk tidy. This is not a hobby when you're involved with the markets, because there are too many distractions already, and we really don't want any more sitting on our desks. So get all the paperwork and all of your stuff off your desk, or find a place to dedicate to your trading, that special place that you can use just to sit down and think about the markets. And I've always said that you don't need the state-of-the-art software, just basic good computer and nice screens that you're interested in looking at, and a backup plan, which means a backup IT second connection or something, just in case things go wrong there. Successful trading is not about how much money you make, it's actually about how much you don't lose. Finding winning trades is not that hard to do, and we're going to go through that process tonight. But it's really the handback is, and hopefully I can get that across tonight as well, it's really the handback is the determining factor of success or failure in trading. Just an interesting piece of data. I showed this last week. This was out of Bulkowski's book on chart patterns, and he basically did a summary, really basic summary of breakout patterns, that type of thing, and found that within 7 to 14 days were the best returns on a basic breakout. If you hold it forever, your return diminishes over time. The average of averages says that. So it's interesting because markets go up, markets go down, and this was proven to be the best sort of window, if you like, for a breakout type of trading. So the purpose of these tutorials is to build a strong foundation in the correct application of technical analysis. So I'm very big on this, on keeping this in as simple as we can, because the more complicated you get in technical analysis, the harder it just becomes, far more confusing, far less useful information on a day-to-day basis. So we really want to keep things nice and simple. And here we are at this point now where we really want to start you on the road to discovering your own trading plan and understand your own risk and get some account management going. So as I've always said, consistently said for many years, that the technical analysis is really just the application of looking at past data. Everyone knows that, and from that we get to build some rules based on a similar or recurring events, and I mean similar, not exact, but they never are. And then we simply identify entry and exit conditions. So technical analysis is based around this observation, if you like, of the markets. It's no matter how much you understand about technical analysis, it'll never make you a better trader. Trading is around about keeping basic records. It's around controlling your risk and money management, position sizing. We'll look at that today. Brokerage, if that's important to you, and then around the psychology of profit and loss. I'm going to talk about this in this session as well. But you can see the concepts on the right-hand side really have nothing to do with those on the left-hand side. They're a skill unto their own, and the two really don't mix together, but they are both required to take a look, at least a profitable look at the market. So this week we're looking at building a trading plan, the very basic building blocks of getting a trading plan together. A lot of people say, what is a trading plan? And they say, well, you know, you should write down all the things that you're looking at or doing in there. Well, no, it's trading plans can come down to basically 2 or 3 lines of information, and we'll go into that. So this week we're looking at trading plan. Now, week 1, I'm going to go through this again. Week 1, we spent defining the trend. You'll find these videos up on the FP YouTube site. You can go back and review them there. But week 1, we looked at defining a trend, and we said that the primary trend, the bit that we're interested in, primary trends are only observed on weekly charts. And I stressed with participants that looking at trying to find out where something is going on a daily chart is nice, but it really doesn't help. You've got to stand back and look at a weekly chart in there. So trend requires an observable trending action, and we're using only the price only. It requires a large time frame chart. So trends aren't devised around moving averages as such or any other type of indicator. So trends are developed on trending action, consolidation, which is your secondary movement, and a very, very important part of your analysis of charts is this secondary movement, and this is where we get our basically entry and exit points out of potential trades, and then some corrective action inside the price chart. So often this is how we look at a primary trend. We start to see the market's formed a low, and over time has formed a high and has retraced, and hopefully we see the price push out to a new high than the previous high was. These retracements should be at least 10% or more. They can, and I would point out that these retracements generally end up as about 33 to 66% of the original advance, of the original, I'll get my pen out, of this original advance. These retracements can end up as 33 to 66% in value of these advances. And this retracement in itself should be about 10% of price. And then we're looking for it to move over the next high. Hopefully it'll make a higher high before the next retracement comes in. And we're looking for this pattern to continue to say that there is a primary trend. And then at times we see the opposite occur, where the market puts in a lower high and then breaks the previous low, which was just a continuation of higher lows. At this exact point here, the market is determined to be in a downtrend. If you take a look at gold, gold is in a primary downtrend, a lot of other stocks as well, and a lot in an uptrend as well. So it really comes down to an individual observation of each stock. We can apply this model to, and also indices and commodities. And then the downtrend in this little picture here continues. There's basically trend analysis in a nutshell, and this is all we're looking for up here on a weekly chart. Must be observed on a weekly chart. And this is what it looks like in our price action. We're a series of higher highs and higher lows, and I encourage you to mark up your charts just with these points on them as a reference point. Just learn how to save these things on your chart. It's Iris and MT4 both automatically save the notes on your charts for you. And where this becomes or brings a lot of untraders undone is in this picture here, we may have a nice weekly uptrend going on. And when we look inside these secondary types of consolidation, and the secondary markets are defined when price bars overlap each other, when they get into this consolidation phase and simply overlap. And these are the primary moves. The primary move here, there was a small one in here, secondary market here, this retracement overlapping each other, and then the primary move again, and then a large secondary market at the top. What occurs for most people is that they look into looking at their price action. And when these secondary retracements occur in a weekly chart, we see that in the daily chart, it looks like a downtrend. So everyone's go, okay, well, this is downtrending. No, it's not. It's just simply, or can be, a retracement inside a larger time frame. And it's the larger time frame is where the big money plays, and that's where we want to play with them. So be aware of your time frame analysis of your charts. If you're looking down into smaller time frames, 1 hour or 4 hour, 1 hour, 15-minute, that type of thing, at least look at a higher time frame to find out where the overall trend is going. As an example, AGL, nice primary downtrend. This is a weekly chart. High, low, lower high, lower low, lower high, lower low, and I think just recently it's set a lower high again in here as well. Then in week 2, we looked at defining some very simple concepts around price action. I'm going to take a look at 2 of these tonight in devising a trading plan. One of them was basically a pivot point, and a pivot point is set up where the market has made a downward move, lower highs, lower lows, until we get to the final bar that's a low. Then the following bar sets a higher low, and the close of that bar is over the high of the bar that makes the low. So this becomes our spike low. Because it has a higher low either side of it, becomes a spike low. But the pivot point is defined when the closing price is over the high price of that bar that makes the low. This operates in all time frames. So it shows as a spike low, closes over the high of the low bar, and it can be within 3 bars. So we've said, well, if we bring in a hard and fast rule that says we'll allow 3 bars to develop to see if there is a pivot point in there, we can often see an inside bar or a bit of consolidation in the market, and then the move gets underway. But it's this closing price over the high of the bar that makes the low is what interests us in pivot point trading. And the same on the bearish reversal points. Shows up as a spike high, has a lower high either side, and the closing of the 3rd bar must be below the bar that makes the high, the closing price, not the range, but the closing price must be below there. So it traps the buyers up higher than the closing price. And again, we can operate this within 3 bars. If it takes 3 bars to get it done, anything after that, you've really got the risk of further consolidation coming in. So if we set a hard and fast guideline, it takes away a lot of the noise for us when we're looking at price action. And then we looked at a 3-bar reversal, which is essentially the pivot point, but will allow the 3rd bar to remain inside the previous 2. And we're looking then for a break of the low or a break of the high inside that range to give us some direction. So this often alerts us to something is cooking. These can easily turn into a bona fide pivot point, but a 3-bar reversal is also a repeatable reversal pattern you'll find in your charts as well. So we want to then introduce a further condition around that and say, well, if we see this type of pattern, we're looking for the low to be at least 8 bars low. So a simple count back, 1, 2, 3, 4, 5, 6, 7, 8. And it's the lowest low within 8 bars really defines this pattern out rather than just looking inside a consolidation area. We're looking for a retracement and then a reversal out of there. This old buy low, sell high concept coming into play. But we look for an 8-bar low count back. So we just simply count the bars back, 1 bar, 2 bars, 3 bars, 4 bars, 5 bars, and so on. I've got some examples of that as we go tonight. So we'll take a look at that. Then week 3, we looked at indicators and some really basic concepts around indicators. You'll find enough information on the internet about how indicators actually work. Investopedia is a good site for that, describing how indicators actually work. That's not the bit that interests us. The bit that interests us is the anomalies that indicators point out. And one of the better anomalies is this bullish divergence concept, where price comes in, makes a low, has a bit of a rally, price makes a new low down through here, but we often see in a relative strength or even in a MACD or a stochastic, we can often see the low come in, the price rallies, the indicator rallies with the price up here, and then as the indicator retraces, as the price retraces, but it actually makes a higher low. and it shows a different characteristic of price movement in here as there was in here, and it shows up in the indicator. Becomes a very, very good tool for looking at a change in momentum as an early indicator. It can't be the reason necessarily to take a trade, but if you look for this in the early background, if we're out looking out here and you find this in the background, this gives me a lot of comfort. So an example here, indicators are based on the closing price, so we do not use the range of the bar, we use the closing price observation. So the closing price here, the lower closing price here, and we saw the relative strength make a low here, had a bit of a rally here on this bar, and then pulled back and made a higher low, even though the market made a lower low, and that becomes our divergence. So this high point in here must be above the 30 level and below the 50, and that sets it up with a hard and fast guideline to work with. The same with bearish reversals. We often see prices make a new high, and then as the relative strength makes a lower high against the market making a higher high. This bearish divergence shows that the high got there on a slowing momentum, gained in points, but did it on a slowing momentum, and that's what we're interested in, is where there's a lack of enthusiasm at high places as a place potentially to exit. In Bitcoin, we talked about this in week 3. In Bitcoin, there was bearish divergence developing between the RSI and the price itself. So the closing price here, and RSI highs through here, and the highs coming in through here. It's after it's dipped below the 70, but not below the 50, rallied above the 70 again, and now we're into this divergence in here. We saw in the weekly chart there was potential divergence coming up as the market pushed into a new closing high, but the RSI failed to make a new high. And as it turned out this week, we saw Bitcoin trade back down through the 17,800 mark just a couple of days ago, and the weekly chart has now put in a spike high and has the potential to put in a pivot reversal. So it's all of these things added together, very, very simple observations around price action can give you a very comforting picture that you can work with and build a trading plan or build a trading approach around. We also made the comment that the relative strength, once in the weekly chart, for example, and I'll show you some examples of this tonight. The weekly, when the relative strength gets over 50, and this is our key level for momentum, is when the relative strength rises over 50, we often see the beginnings of new primary moves within the market, and it becomes a very, very good observation. And also made the comment that relative strength over 70 is not necessarily a bad thing, and often we see the first movement over 70 was just here, and the price went substantially higher at that point. This was on US dollar gold. So this over 70 thing is a bit of an overkill, a bit of an overstatement in many cases, but it is somewhere to watch for potential reversals around divergence, that type of thing. And then we're always looking in our price action for evidence of potential reversals as well. So here we are in week 4. Going to look at the building blocks around this. We've got some ideas together around some indicators. We've got some ideas together around price action, and now we want to start to build a bit of a plan around that. So one of the realities of trading, and this is the first thing you must approach when you're trading. Everyone, particularly now that we've got a lot of people looking for something else to do, is a better way to put it, and they think that trading is their answer to all of this, and they find out it's probably the hardest thing they've ever done in their life, far harder than their career advancement. But the realities of trading are really deciding around, working around whether you're single, you're a family person, or in retirement age. If you're a single, you're generally running a smaller account but leveraged, and a family person must separate out the living money from investment money. You cannot trade your basically grocery money, if you like. It's simply a foolish thing to do. And if you're retired, you're looking at a lump sum or super money investment into the markets, which you really can't put at risk because it is your retirement age. So it's things that really sit down and ask yourself, where am I in this picture? and what are my risks here going forward if you consider the worst case scenario. Simple volatility is something that a lot of people misjudge around markets, and I'm going to show you something around an average true range tool. It's a volatility tool. We take a look at an average true range of 3. So what the average true range does is looks at the previous close against the current high or low price and calculates out a value into the ATR value. And so it looks like this, where the previous close against the current high or the previous close against the current low, the tool creates an average value. It can be averaged, all of this can be averaged out over many, many days to whatever you nominate. But it gives you a picture of potential price movement or volatility of the price itself. So in here, on the left-hand screen, we have, this is the Australian SPY contract, ATR of 94. So what I've done here, the blue line here is your 3-period ATR, average true range over the past 3 measuring periods. And what I've simply done is put a red line and averaged out that and said, well, look, the average of averages here is around about 94 points. Now, this is a rule of thumb. I'm getting to a point here. This is just a rule of, just an observation. And if we take the index value, another way of looking at this is simply divide that into the index value itself, and you get a decimal number multiplied by 100, which basically says you're looking at about 1.4% over 3 days. Now, which is interesting. You'll find most stocks, most equities operate in this sort of window of around 0.5% to 1.5% over 3 days. Currently seems to be their average ATR. One of the interesting things about Bitcoin, when you look at Bitcoin, and I've drawn my red line through here, around about $849 a day is its average 3-day movement. Over 3 days. We take that, we divide that by the current price the other day, we come up with a number, and we find out that Bitcoin has a potential to move around about 4 to 4.5% over 3 days. Now, you add a bit of leverage into that, and we find that dealing with this type of price movement can be extremely taxing on your mental state, if you like, if that's the right way to say it. It brings in a lot of pressures that we don't normally deal with on a day-to-day basis, where we're seeing accounts swing around because volatility, and Bitcoin is essentially the highest volatility value against everything, against currencies, against commodities, and against equities. It is really out there, and I've seen this number much higher than this in years gone by. What that means is that we've got a little chart of Wesfarmers here, and basically same thing again. ATR is 3. You'll find this in TradingView and also in MT4. And I've drawn my sort of average line through here, basically 87 cents in there. That means that basically, if we divide the current price, 0.87 divided by the current price gives us this decimal here times 100, which means we're looking at about 1.7% average movement over 3 days. Now, if you bought $10,000 worth of stock, paid for it in full, you'd end up with about 200 units. And if we took that range, that means that this current price over here, the current range of 1.7% sort of puts us into the $50.43 down to $48.69 would be its average price range. So if you're looking at 200 units in there, basically your account will change by $174 or potentially change by $174 on average over 3 days. Now, this is just a simple guideline, but it points out some interesting things when we look at potential price movement. So when we start to bring in CFDs into this, on a $2,000 deposit, we end up with a range of 174 each way, again, same as above there. But against our $2,000 deposit, or our margin, if you like, against a $10,000 position, our account will look like it swings about 8.7%. So it starts to get out there with that. And then when we go the next step and say, well, look, I can leverage this up to, because my $10,000 that I originally put in, I can actually leverage this out to $50,000 now. It allows me to buy 1,000 units in there. That means my swing range is around $874, potentially over 2 to 3 days or 4 days. This is far different and changes your sleep patterns if this is not working for you. It can change your sleep patterns very quickly in there, and it looks like this. Now, the issue with this is not an issue. I mean, it can work. I fully agree and have fully used it. It can actually work against you in a very good way. But when things don't go for you, and you have other pressures in life that you need to deal with, it becomes a serious issue. So when you build your trading plan, when you start to think out who you are in the markets, this type of observation needs to be taken into account as to what the realities are of price movement along the way. The issue with all of this is when we take a normal decision process, and I assume I'm bringing everyone into this envelope that we have this normal decision making process around everything that we can control. So we'll look at something and we'll make decisions about it because we can ultimately control it. We can control the outcome. And I've got an example here that if we were buying a car or an electric kettle or something off that we had a choice from, our first choice, we look at, say, example, a car or even a television set. We have a first choice that we'd like to have, a second choice that we'd like to have, and a third choice that we'd like to have. So we have all these choices available to us, which is fabulous in day-to-day living. And then we need to go on and go, okay, well, if we need to then fix on one of those and find out which one I really like, and then if it was a car, we could take it for a test drive, and if we don't like it, we can take it back and test drive another model or something, another level of car or something like that. But we have a choice to take it back, do what we need to do with it. And then further to that, once we get interested, we have a fixed choice around color. We've fixed our choice. We can pick a color. We have a choice of 6 colors, no problem. We can go through that and decide what we want out of all of that. And then finally, we get to make our payment or our final choice, and we have payment made right there. So we have all of these things that we can change along the way. It's what we do every single day around every single thing that we do. We simply make choices about what we accept and what we don't accept in our daily lives. The issue with all of this is that these last two, once you pick your color and once you make payment, it becomes the ultimate commitment. So picking a color requires commitment, and then making payment and accepting delivery requires commitment as well, whether it's a car, a TV set, or whatever it is that you're buying, a computer or laptop or screen or whatever. Once you make payment, you have the ultimate commitment. The thing about that is that once you get past delivery, once you accept delivery of that, and things don't go well for you, we have a myriad of options open to us. We can take it back, we can call them back, we can get it changed, we can get a refund in this country. If the delivery is late, if we're expecting something, which everyone's getting deliveries these days, if the delivery is late, we can make a phone call and calmly ask where it is and what's holding it up. And if that sort of date comes and passes again, we can make a second phone call and our stress levels go up, and we can make a third phone call. And by the time we get to the fourth phone call, you can imagine how that's going. However, we still have a lot of choice around all of this, not about how we act so much, but about the options open to us. We can still go back and cancel things. We can take things back. We can return things. All of these things we have open to us about how we conduct every single thing around our daily life. This is a learned process from childhood. It comes from observing our parents. There's a lot of books written around this, but observing our parents, observing how other people do things, and it becomes a learned process about how we deal with life in general. The thing about this in the trading decision process, when we get down to the stock market or the futures market or the currency market or anything like that, we really sit down and do some work, and I do this every day. I do the work and I investigate and I look at things and ultimately take some action. And once you click the buy or sell button on your mouse and that order is processed through the system, at that point you have control over nothing. And I'll go over two things that you do have control over, but you have control over nothing. So the first thing that we have control over is the entry level. Got that? No problem. What happens after that is now solely a process of the market. What happens is we get to monitor the progress of that decision that we made, and then we understand the results and its implications, whether it's good or bad for us. And then ultimately we get to the point where we say, was the result as we expected? And if the answer to that is yes, then we actually feel pretty good about it. You know, we feel pretty good about a trade that's gone our way. We've done the work and it's worked out exactly as we thought. It's hit a price target, or gone to a level that we expected, and we exit it, and the money ends up on our side of the ledger. So we feel pretty good about all that stuff. The issue with this ultimately is if it doesn't go our way. The trader breakdown system says, well, we're basically upset now, and often the reaction is your first internal reaction is, how do I manipulate this? How do I make this make me feel better? And what can I do around it? And then you ask, well, where did I get the information, or who didn't get their job? Or where did I get the information? And we start to look around us to blame who created this situation where I failed? Did I get the tip off one of the tip sheet sites, or broke a node or something like that, anything like that? And we start to look for other things and places to blame around our trading outcome. And the simple reason for that is we have no recourse. There is no return counter. There is no one you can call to say, I didn't mean to do that. Anything like that. If it turns out the way it is, it turns out the way it is. And that's the same as ringing up your car dealer and say, send me a car. And that's it. And you get whatever comes up your driveway. You got a car, but it may or may not be the one that you wanted. And this is the wall of trouble that traders often work up against, is this because it becomes part of ourself, or we think it becomes part of ourself in there, where all these things we can't control, we seem to take personally along the way, and it becomes us. If we really put it back to say, well, these things I can't control, then it becomes the trading game. So a trading plan, when we talk about a trading plan, it creates a somewhat known outcome at the end of the day, a somewhat known outcome, and I'll go there and explain that. So there's no gut feeling required in this. I see a lot of social media posts, if you like, talk about, well, I've got a feeling it's going to go here, I've got a feeling it's got to go there. Well, that's nice, but that doesn't sort of put food on the table. So, and it's often wrong. A lot of notes been written about human biases, that type of thing, which is essentially comes down to gut feeling. Gut feeling doesn't make any money for you. I'm here to tell you, after 20 years, it really doesn't make any money at all. When we start to create a trading plan, there are two things that we can control. The two things that we can control are the entry level and the stop loss. They're the only two things that we will ever know about placing a trade. Is once that button is clicked, it's either going to do two things. It's either going to go to a place or do something that we like, or it's going to hit our stop loss and we're out of there, and we've handed over some money to the market that we cannot get back in that immediate process in that particular trade. We can't ring anyone and say, look, I didn't mean to do that, or that wasn't really what I wanted to do. That's actually what happened. So we have an entry level that we can control. We can decide what price we're going to buy or sell at. And then we have a stop loss set. And I'm going to go through the importance of this stop loss application. And then after that, as things progress, we find out that the upside of this entry point This side is unlimited because we don't know where it's going to go. It can go anywhere. We're seeing at the moment a lot of the day traders are getting excited about 100% moves a day, that type of thing, and 50% moves a day. So essentially the upside is unlimited when we look at stock price and that type of thing, commodity prices. This is the true definition of it. Of course, there are limits around values and all the rest of it, but essentially the upside is unlimited. So we don't know where it's going to go is what I'm trying to say. And then we can say, well, the downside is the only thing that is limited. So our stop loss is something that we know, and this side is limited. And this is the tragic consequence of when most people start out in the market, they think this side is they don't take this view that we can limit this side, and they simply let this side just do the damage to their accounts that doesn't need to be done because they have really stuck in this place where they don't know who to complain to if they stop the trade. It's who do I go back to? So this idea of stop loss, this is the only single thing that will ever make you any money is controlling of this stop loss. In the stock market, it is the only thing that will make you money. The other side will look after itself, but this side is the only thing that you can control apart from entry level, and it's the only thing that will make you some money in the markets. This is some of my work from Thomson Reuters. I submit work to them, and this is really just an observation of a trading idea. It's fairly loose, but all I do is I look for an underlying trend, high, low, higher, high, higher, low, higher, high, higher, low. Excuse me. I then look for a pattern in most cases where it has 3 points in it. Just textbook stuff. You'll find this in all the textbooks. Then I said, look, here's where we're buying, here's our price target, and here's our stop loss. Use of an indicator, in this case, it's stochastics, made a swing, and the relative strength is always over 50. To create a buy entry, your relative strength is always over 50, and it's on a weekly chart. Now, this is just one example of something that went in. This was just a couple of weeks ago. Was it? It was early. Yeah, just a couple of weeks ago, early November, I think it went in. And the outcome of that was this. So I sent them back a note and said, oh, well, look, take your money. It's met the price target, just take your money and walk away. And we're starting to see other things where the relative strength has turned over and the stochastic starting to swing back the other way. So essentially, it's done one of two things. It's either met the price target or it's met the stop loss along the way from your entry point. Another one here, this was CIMIC. This came out just a week or so ago. This reversal down here, 1 phase, 2 phase, second phase, and third phase down. 1, 2, 3 lows in there. Then it started to set the higher low. Really simple textbook stuff. High volume, relative strength over 50. And I think so far we're up to here as of today. I took this snapshot this afternoon. Now, and you can see in this example, there was a buy zone set up the top here. This one met the stop loss at the time. The target would have been out here somewhere, but didn't even look like it wanted to go. The target just simply went straight to the stop loss. Interesting that the stop loss here, and I'm going to go through this handing over a fixed amount of your account, but to take the stop loss down here is soul destroying and account destroying without a fixed point of deciding where you're wrong. What I did was I took all of my recommendations, went through them, every single one of them in sequence, put them onto a spreadsheet, and worked out whether this idea actually made any money. And it was based around, here's the code, here is the exchange that's based around the Australian ASX and the NASDAQ entry prices, which was a closing price of the day of the recommendation. The stop loss level that was on the chart, let me go back. The stop loss level that's on the chart here is always a stop loss level marked on there. This is not any special calculation. This is just a line on the chart that says, well, if it gets to here, I'm probably wrong. stop loss level. Then we work out the difference between the entry price and the stop price, and we end up with our risk in dollars, and this creates a position size. I want to go there now and explain this, and a position size in dollars and the ultimate stop. So in the first one here, we went to a stop and we handed over 10,000 bucks. I just used $1 million as a starting balance because I could. And then as it develops out, we see that there's some profits came in, a loss, profit, 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 and so on. Now this strategy comes in with about a 55 to 45 win-loss ratio. Nothing special about it. And let me go explain a bit further about this position sizing. So when we look at account position sizing, now I've used this as $1 million, and I'll use something a bit more realistic in a moment. But $1 million, if we're taking a 1% risk, it means we're risking $10,000 of our $1 million. So it's no different than putting 10,000 bucks on the table and waiting for the outcome. So the minimum loss can only be $10,000 or 1% of the account, and this leaves the profit side unlimited. And we talked about that a little earlier. So the entry price minus the stop equals the risk. If you've got a pen and paper, I would write this down. Your entry price minus your stop loss level equals your risk, and then divided by how much you're prepared to risk, and that gives you a position size. So our entry price, our stop loss level, our defined risk, and gives us a position size to take. In this case, 2,160 shares. This was in the ASX. And then next one, MU in the NASDAQ. Entry price 42.23. The stop was 36.30. The risk was $5.93. Gave us 1,686 units, and the exit date, and that one took a loss as well. So all we're trying to devise is say, okay, if I'm wrong, I'm not handing over an undefined amount of my account. I'm handing over a fixed amount of my account if I'm actually wrong. This will save your life. This will change your view or your attitude to taking risk in the markets. If you do work through this simple exercise, you can set the stop wherever you like. It doesn't matter, because we could take a risk of $10 on this position, and it's simply the $10 divided into 10,000 would give you your 1,000 units over here. Just changes your position size. So whatever happens, it goes to our stop loss. It just means that we hand over a fixed amount of our trading account, not an undefined amount of our trading account. And right there is the difference often between long-term survival in the market and no survival in the market, is how fast you destroy a trading account. All of those on that spreadsheet turned into an equity curve like this over time. And we can see in the equity curve that we had flat spots along the way, and then a decline in here, and then it rallied again. And the current decline over here. So this was a sample taken out of 2019 over a 6-month period. This one here was another sample taken over a 12-month period, and the equity curve simply went this way. But again, we can see during periods, and this is looking at equities on both the ASX and the NASDAQ, there are times when the markets just don't want to do it for you, and we end up with these drawdown periods in here, and then as things settle, we see our equity curve improve again. And here again, and a long flat spot. There's about 65 positions taken in here where the equity curve really didn't improve until it broke out and headed on its way again. In my own trading, this is an equity curve in one account that I've got. We started with a balance of 85,000 in there. You can see it's been a bit jagged. This one went through the stop loss, gapped away. This was just a lucky break. This one up here. This was the February drawdown earlier this year, and now we've recovered back into a new high just as of a couple of days ago. So and there's not a lot of trades taken in here, but I have a simple strategy around the Reuters observation that we looked at earlier, and it sets up this type of curve. So let's take a look at this position sizing around this percentage value. Now, if we look at this in, I know there's a few currency traders here, so we'll take a look at this now. And we're using now an account size of $10,000. So we're going to risk 1% or $100. We simply, in the currency, for example, we take our $100, we divide it by our pips at risk, which is essentially the distance to our stop, and gives us a position size. Now, I understand in MT4 and Iris, they have fixed lots, so this would simply divide out into 0.3 or 0.4 contracts on there, and it gives you a fixed, basically says that if this goes to my stop, I'm simply handing over $100. So the minimum loss can only be $100 or 1% of the account, and this leaves the profit side unlimited. So in here, I've got an example. I'm going to go through some examples now of some of the setups that we talked about in the past weeks. And just to go through what we're looking at on the spreadsheet again, at the direction, so B is a buy, S is a sell, of course. Our entry price, the stop price, our decided pips at risk, our position size, and I'm going to use a 6-bar exit. So it simply says that we're out of here after 6 bars. No matter what happens, we're out after 6 bars or the initial stop loss. And so then there's a win-loss, and in this case, 77 pips, and came in at a $292 profit. So what I did was during the week, while everyone's been sipping lattes, I've been beavering away at this one chart of price action, and I have marked off all of the pivot points, all of the simple pivot points that we talked about, where the market makes a low, and then we see a closing price over the high of that low and creates a pivot bar, and of course the reversal mirror image is the same as the reversal one. And I've used this is where this is the important bit here, is at the entry level is a closing of that bar, and the stop is at the low of the entry bar. And I've gone through here, I'll pick up here at number 3 down here. So this is the bar that makes a low. This is our entry level here. 1, 2, 3, 4, 5, 6 bars, and we're out. And so item number 4, pivot point, this was the bar that closed below the low of that bar that made the high. So that was our entry price just here. 1, 2, 3, 4, 5, 6 bars, and we're out at a small loss. And so this one is not a true pivot because we haven't got an 8-bar low in here. This was an 8-bar high. This is an 8-bar low. This one doesn't fit that criteria, so it was left out. This one doesn't fit that criteria, and it was also left out because it's not the 8-bar low. 1, 2, 3, 4, 5, 6, 7, 8 bars down here. So I've gone through here again. This one, the pivot up here, the reverse pivot. So this is the entry level here. 1, 2, 3, 4, 5, 6 bars, and we're out. And the pivot point down here, this is the 8-bar low, at least 8-bar low, pivot bar, entry level just here. 1, 2, 3, 4, 5, 6 bars, and we're out. Now, so this is our trading plan. A pivot point, a valid pivot point, 8-bar low or 8-bar high, and we close on stop or the 6 bars. That means we closed on the low of the entry bar if that low was broken, or we closed after 6 bars. And I think there was a couple of here, this one here. This one created a pivot entry in here. This is the high, the 8-bar high. This bar created the pivot, the entry level here. 1, 2, 3, 4 bars, and we've crossed the high of the entry bar just here. So that becomes our exit. So what I did was I wrote down all of these into a little spreadsheet, and it looks like this. And just a simple, and this is where you really need to do some work to just simply understand what you're trading. So I've gone through and put in my, whether it's a sell or a buy, put in my entry price, put in the stop, which was the low of that bar, the pips at risk, created a position size, and then whatever happened at the 6-bar exit or the stop was taken out, and then we ended up with essentially a pip count on there, whether we won some pips or lost some pips along the way, and then our profit and loss. So first one was a profit of $99, next one was a loss, and then a profit and then a loss. So our losses can only be $100. And so at the bottom, when you add all of this up, we made $748, we lost $648, so an overall profit of $100. That's interesting. So we had 6 wins and 8 losses. So we had more losing trades than we had winning trades. Now, I'm not suggesting this is a trading plan might not even suit you, but what it does is bring structure to your thinking around price action. We can now break our charts down into pivot points, into structured pivot points, and say, does this idea actually work? Simple tests like this is just a little proof test. In here, when it comes down to really getting into it, I would suggest you collect a lot more data than what's on this page. I would suggest a couple of hundred entries to begin with, but what it does is I go, okay, well, maybe this is worth investigating and this can be my trading plan. You see, the issue with all of this is that when you start to think of the markets from this concept, we already know the outcome. You know, if we know that we're going to lose 8 out of essentially 14 trades, and we know there's going to be 8 losers, then it was as we expected. There's none of this, oh, I didn't expect that, what can I do about it? Well, it's okay, you know, it's not never comfortable, but well, I already know that could happen. It doesn't become a surprise to us in our trading. Then I went through this again on the pivot points, and I said, well, what if we changed our entry, kept our same entry level, but we put the stop at the back of the low of the lowest bar in there? Exactly the same pivot point, 8 bars, high or low. We close on the stop or we close after 6 bars, but our stop is now a bit wider. And what we find, of course, is our position size is considerably smaller. In this particular case, we had 8 wins and 6 losses in there. We won $601 and we handed back $495. So we had roughly an equal outcome of about $100 return on that. But it changed our win-loss ratio just by simply changing where the stop loss was and changing our position size. And we can see in here that we never, in none of the cases, we never lost more than $100 or 1% of our account. It leaves the upside unlimited. So if you get onto something that's gone quite strong for you, it adds to your account and you avoid things that go badly against you, which you never know about at the time of entering a trade. So this is the firewall, if you like, against protecting your bank account and your lifestyle. So I took this a little bit further. Question here about, do you ever use alerts instead of stop losses? The reason is stop losses can be hunted by spike high and spike lows and essentially be hunted. Yes, that is true. So if you know that piece of information, don't put your stop at the highs or the lows. Put your stop, go through your charts and work out what you think the stop's going to be hunted at and add in what you think you might willing to risk outside of that. If you've got to move your stops out wider, that simply just changes your position size and you end up with the same outcome. But it's a great question, and it's a lot of people get bent out of shape over this stop hunting business, and they think the market's working against them. The market creates a victim out of them, and I would suggest to you that you create your own victimization out of that simply by not doing the work on your charts. So here we have, but it is a fabulous question and it's something everybody should consider. So looking at the changing of our, simply changing our stop position, it changes our position size. We can't lose any more than 1% of our potential trade outside of a gap. But what it did do was change our win-loss ratio. So I took this one step further again. And we talked about moving averages. So here's the same chart that I used for the pivot point exercise, and I've put on here a 5-period simple moving average. and said my trading plan is long only, so I'm only going to enter long trades. I'm going to enter on the close above a 5-period simple moving average. So I've got them numbered here. First one up here, this is number 1. So this was our close above the 5-period average. So this is our first trade. Our second trade down here, the close above the 5-period average. Our third trade here, close above the 5-period average. And interestingly enough, we can see our first long trade went to a loser, the very next bar. Our second long trade went to a loser on the second bar, and our third trade went to a loser on the very next bar. Our fourth trade, this was our entry level just here, 1, 2, 3, 4, 5, 6, and we're out. And our fifth trade here, this was where the close was above the average, 1, 2, 3, 4, 5, 6, and we're out up here, and so on. So I went through and I worked that into a spreadsheet. Exactly the same thing. The long only trades down here, there was 18 of them on that sheet. Entry price, stop price, your pips at risk, your position size, and then the exit, whether it was stopped or whether it was turned into a profit. And we can see here, the first 3 was stopped, $100 loss. Next one turned into a profit, a couple of losses again, small loss here. And we ended up here with $1,118, 7 wins, 10 losses out of this. And there was one in here that basically came out at 0. So that's 7 wins, 10 losses out of 18. And we ended up with a profit of $194. Okay, so that's interesting. So what we do then is we take our win-loss, loss, that should be, yeah, that's right, our running balance, and then 216, and we build an equity curve. And this is very, very rudimentary, but what this shows is our initial losses down through here, then we came into profit, went back in here to a loss again, and then started to work in as our equity curve starts to work higher and higher, and currently a higher low here, and so on. So we get to look at this a developing strategy inside these markets. And if you're looking at equities, at least do this over equities or futures contract or anything that you're working with. Go back and build a basically back of the envelope proof, if you like, first, and then get further and further into it if it interests you, and you begin to understand how compelling it is to take a trade when you see it, because you really don't know the outcome, but you're comfortable that if it works against you, you can only hand over a certain percentage of your account. And now we have a business, not roulette, if you like. This becomes a business now where our business is to operate our trading plan. And I would suggest to you that if you're sticking to your trading plan, then trading psychology is something for people who don't have a trading plan. When we look at this again, what I did here was used exactly the same data, the entries and the stops. This is on our 5-period simple moving average. But I put in, let's say, one contract, 100,000, 100,000, 100,000, without any position sizing. What would the outcome be? And so we went through the win-loss ratio again, and we found out the numbers are much larger, with $3,200 on the positive side and $1,940 on the negative side. So the profit was considerably higher at $1,260 in there. Now the equity curve, out of all that, you think this is fantastic, but let's take a look at it really. So here's the equity curve. Now the equity curve suggests that really from about position 5, we really haven't made any money. We've bumped along simply at the same equity. Now let me go back on that and explain this. Have I gone back one too far here? Yep, sorry, I'm right here. This type of risk in here means that our losses are essentially much larger than what we would normally accept. And that means that using this size contract, our losses can be substantially larger than a fixed amount And that is important in here, that if we happen to take 3 large losses, it will simply undo all of this and bring us back to somewhere below where we are. Now, the equity curve, just by simply position sizing, we're starting to get a bit of a trend in our equity curve, and without any position sizing, it really shows that we've had a great start. Bravado is up, but we really haven't made a lot since then, and we run the risk of actually handing that back, of course, as well as advancing, but we run the risk of handing that back. So this sort of approach really doesn't require any trading psychology. This requires that you have a business plan exactly the same as if you had a shopfront business or a other sort of service business. You have a trading plan, you have a business plan. This is exactly the same thing. It doesn't require a lot of psychology in it, but you must believe in your product. And if you start to do a little bit of back testing, even by hand, which I encourage, it will build your belief in the pivot point system if you choose to use that, or moving average, or whatever you choose to use. Then that will enhance your outcome. So getting back to our little flow chart here. So we looked at this up here and we decided that we do the work and investigation, we monitor the progress, we get the result and its implications. And the answer, yes. Was it feels good? Yes. Well, you know, I feel pretty good about that. But if the trade doesn't work against you, that is also a yes answer. That is now what we expected. If we understand that we're going to take 8 losses out of 15, yes, that's what I expected. That's what we can only expect. So there is no blame game in here. It just means that it's, you know, never a great thing, but it just means we have to look for our next trade. That's all it says. So I'm going to leave that there. The questions, if you've got any questions, they really should be up by now. Next week, this video will go up on the FP Markets YouTube site as week number 4. Next week, I'm going to recap on this, and I'm going to go through some more actionable price patterns, and we'll go into a much deeper Q&A next week when we sort of bring everything together again. So the question is there a template that you use to show the basic risk and equity curve that we can download and use to journal our own trades? The answer is no, just an Excel spreadsheet. If you aren't familiar with Excel spreadsheets, do it in a ruled book, and get your pencil and rule up some lines and just write it out yourself. It's incredibly enlightening when you start to work your charts and work your price action by hand. That is, yeah, if you're really interested in Excel and aren't sure about it, I went to a TAFE course for a week to understand it, get the basics of it. And there's still a lot I don't understand, but it's or find a 16-year-old and they'll help you out with that. So yep, expanding the comfort zone. Yep, okay. All right, if there's no questions around that, I'll give you a minute or so. So again, as I said, next week we'll look at some of these, expand on our price pattern concept and look at some bigger picture applications around equities and commodities, that type of thing. And we'll get into really a Q&A about anything that comes to mind during the week. All right, thank you very much, everyone, and we'll see you next week.